We're a biotech royalty aggregator providing non-dilutive capital. We play in a part of the sandbox that many others don't because we're willing to accept binary risk. Many people confuse the idea of raising capital as success versus the idea of preserving value per share is success.
Onyx Live is proudly sponsored by Humphreys Law and Panacea.
My name is Brad Sitko. I'm Chief Investment Officer of XOMA Royalty. We're a biotech royalty aggregator providing non-dilutive capital to companies and universities and inventors in exchange for royalty rights or milestone rights.
Okay.
And I'm here today with Onyx.
Fantastic. Well, we're really happy that you could join us. So
My pleasure.
let's deep dive into that. How exactly do you pick a company and how do you allocate capital?
Yeah, absolutely. So we're a publicly listed company on NASDAQ, so we allocate capital based on our balance sheet. And what we're looking for is opportunities where we can acquire future economics, so shares of future net sales of drugs or milestones from when partnerships have happened between a biotech company and a pharmaceutical company. And the way we allocate capital or choose opportunities is we find interesting science that we believe is going to be solving an unmet medical need. At the end of the day, we're looking for something that's going to be life-changing for patients and help improve the human condition. And what we look for for deploying capital is it an attractive royalty stream and a partner that we believe can actually create and add value and take the program through to development and ultimately commercialization.
So what types of returns are you hoping to garner and over what time scale?
So we look for venture-like returns over the life of an asset that we acquire or a royalty asset we acquire. So we think about very long duration types of returns. We're in a riskier segment of the royalty business that when we get things right, we get them very right and it's long-term rewards, but we have to be comfortable with the fact that when we're wrong, the capital that we've allocated could become a zero.
And when you're investing in a private company, what sort of stages do you invest at and do you return in each round? Yeah,
so we don't actually invest in a company itself. We're buying from a company, whether it's private or public, the royalty rights that they'll have on a drug, typically that they've licensed already. So when you have a partnership in place and the biotech company has licensed a drug and their intellectual property to someone who has more developed resources and capabilities and can take a program through clinical development. That's what we'll look for. So we're underwriting, in the way you think about an investment, to the partner that's developing the asset itself. And what we're looking for then is the capital need of the company that we're working with, who we're buying the royalty rights from.
Sure. So I suppose, given the nature of what you're dealing with, those are generally mid to late stage companies as opposed to those earlier in their infancy.
Right. So, well, the companies can be at any stage of their infancy. What we look for more is what is the stage of the product that's going to be generating the milestones or royalties that we'd acquire. And for that, we're agnostic. I think the key thing that we look for is the royalty industry can be very crowded, and we've chosen a very differentiated spot within the industry. You know, we play in a part of the sandbox that many others don't because we're willing to accept binary risk or failure, you know, during the stages of clinical development. So like when an asset goes from phase 1 to phase 2, phase 2 to phase 3. Like we embrace that level of risk, and we think that that's important for our model to understand that risk has happened, and we can be comfortable with that. Many parts of the royalty industry wait until a drug is already approved and generating royalties and being sold, and patients are being actively treated commercially. And so they behave much more like a credit-oriented mindset, kind of like debt-like. And we think of it much more in an equity-like mindset. And by pursuing that strategy, we've aggregated a portfolio of over 140 assets, which allows us to think about diversification and risk diversification.
Sure.
And that's important because, unlike many other folks that deploy capital in this space or a private fund, we're a public company. So we're delivering to our public investors kind of a risk diverse basket of assets, and a way to participate in the pharmaceutical industry without having to have the risk of, is a trial going to take longer and cost more money? Is there going to need to be additional equity raised to make a trial successful? We kind of separate out that risk and those dynamics by playing for the best of, and then kind of having a very streamlined economics.
And why do you think this sort of model of investment is particularly attractive to CEOs and to companies compared to more traditional models?
In the last couple of years, we've seen that investors are becoming much more sensitive to how their capital is being used, especially equity investors. Many times we've seen companies struggle to raise money through the equity environment, or we've heard the phrase last JPM, equity has dried up. And in the type of capital that we provide, it provides economic dilution against a single specific asset and doesn't force the company to cut the proverbial pie into more slices. So what this does is it means for the investors who invest in a company on a per share basis, it allows them to preserve more value per share than they would if they just went out and issued more shares.
And how has your JPM been so far? Who have you been speaking to, and what progress have you made?
It's been a very active JPM. We've had a couple of meeting rooms running all day, every day, back to back. I think the royalty model itself is here to stay, where it's become embraced by the industry as a financing type of priority instead of a financing type, what it used to be 15 years ago, more of last resort. So we're often meeting with companies, founders, we're meeting with investors, universities, and there's a lot of folks that are actively exploring the segment because they understand that it's a very powerful tool for them to raise capital in a way that preserves value, and those conversations have been exciting.
And what would you say is the general sentiment in the industry at the moment, say, compared to this time last year?
I think last year and the year before, the industry was going through tough times from a capital perspective. The capital markets were shying away from risk, and biotech in general is viewed as a riskier part of the segment. The investor sentiment has started to turn around on the back half of last year. We've seen companies raise money, but the reality is there's still around 800 public companies, and not everyone can be successful in raising capital. So people are still looking for more creative ways to raise money. The sentiment is optimistic. I think when you're in the industry itself, there's always positive sentiment because you're trying to change the shape of human health. The overhang can be limited to, the weather in Union Square for the conference week. We have a beautiful day today, but I think overall, the capital sector is feeling positive.
And what would your main message be to CEOs and companies this week?
I think the main thing that I would say to CEOs and companies is think about what is success. And many people confuse the idea of raising capital as success versus the idea of preserving value per share is success. So the less you can dilute your equity holders over time and preserve value by looking at non-dilutive financing sources and alternative ways to raise capital. At the end of the day, when the drug and development is successful and the clinical data cards turn over and you have an approval down the road, you'll own more of something that's valuable, and that's important. The other thing I would say is start thinking about different capital sources early. The conversations take time to develop. Have conversations and touch points early and often. Think creatively and be open to feedback and understanding and preserving that there is risk in drug development. Not every drug that starts in the clinic makes it to approval, and be realistic about the probability of success that you have in front of you.
Amazing. Thank you so much for your time. Really
appreciate it.
It's been a pleasure.
Thank you.